If you've been watching silver lately and something feels off, you're not imagining it. This is what it looks like when a market stops behaving like one market. When the same metal starts trading like it has multiple prices depending on where you are, how fast you need delivery, and whether you're buying paper or physical. And when that happens, you don't get a clean, polite breakout. You get a fracture, a liquidity crack, a sudden split between the price people see and the price real buyers are being forced to pay. That's why this China just hit $85 headline matters. Whether the exact print is $85 or the high $70s plus a violent premium. Because the real story isn't the number. The real story is what the number represents. The moment the silver market starts losing the ability to stay unified. Stay with me until the end. Because the biggest mistake Americans make in metals is watching the chart and ignoring the plumbing. When liquidity cracks, the chart becomes the last thing to update. The first thing to update is behavior, premiums, delivery terms, inventory, reluctance, and the sudden urgency of buyers who can't afford to wait. That's when silver stops being a trade and becomes a warning light. Let's start with the core concept. In plain terms, silver is supposed to be one global price. Arbitrage is supposed to keep it one price. If silver trades higher in one place, traders buy cheaper elsewhere, move supply, and close the gap. That mechanism is what keeps markets honest. But arbitrage only works when three things are true. You can access metal, you can move it fast enough, and the financing and delivery risk is manageable. When any of those breaks, price gaps don't close, price gaps grow. And China is the perfect place for that gap to show itself first, because China sits on the front line of industrial demand. When Chinese industrial buyers need silver, they don't want exposure. They want metal. They want throughput. They want reliable supply, not a promise. If that real demand collides with tight available inventory, the local physical price can lift above global reference prices. And once that premium appears, it sends a message to every major player watching. This market is tighter than it looks now about the $85 figure. In markets like this, a headline number can come from multiple things. A local physical contract, a converted price, an intraday spike, a premium layered on top of a global reference price, or an extreme moment in a thin liquidity window. The important part is not arguing over the exact tick. The important part is recognizing the condition, a widening premium, and a breakdown in the idea that silver is one clean price. Everywhere that condition is what liquidity is cracking actually means. Liquidity cracking is not the same thing as the price went up. Liquidity cracking means the market's ability to smoothly absorb buying or selling is weakening. It means the size of orders required to move price is getting smaller. It means sellers are stepping back, spreads are widening, and the cost of immediate supply is rising faster than the headline price. In other words, the market becomes jumpy, and jumpy markets do not stay stable for long. So why is this happening now? Because silver is being pulled by two forces at the same time, and both forces are getting stronger. The first force is industrial demand. Silver is not just a store of value metal. It is a conductor built into the physical infrastructure of modern life. Solar panels use silver for conductivity and efficiency. EVs and modern cars use silver in electronics, sensors, power systems, and connectivity. Data centers and high-performance computing require advanced hardware, and silver is part of the electronics ecosystem that supports that hardware. Medical tech uses silver's antimicrobial properties. Defense and aerospace systems rely on silver in critical electronics and communications. This is not optional demand. It's demand tied to long-term build-outs. That means in many sectors, buyers can't just wait for a better price. They need supply continuity. The second force is monetary and financial demand. After years of inflation shocks, debt expansion, and geopolitical uncertainty, more capital is treating hard assets as insurance again, not because people think the system ends tomorrow, but because they know the system is more fragile than it used to be. Gold gets the headlines, but silver gets the violent moves. Silver is smaller, more sensitive, and more explosive when attention turns toward metals. That's why silver often behaves like a delayed pressure release. It stays quiet until suddenly it doesn't. Now here's the part most Americans miss. Silver doesn't need a global shortage to behave like a shortage. It only needs a shortage at the margin. deliverable silver in the right form, in the right place, at the right time. Because price is set at the margin. If the available now pool becomes thin, the price doesn't grind higher, it jumps higher. And once it jumps, it draws in more attention, which creates more demand, which creates a bigger jump. That's the reflexive nature of a small market under stress. So what does China's premium this split tell you? It tells you that physical demand is colliding with limited immediately available supply, and that the market is solving the collision by forcing buyers to pay up locally. That is the definition of a crack. The global paper reference can still trade, but the physical reality starts pricing differently. And once that happens, everyone watching should ask the same question. If China has to pay a premium, what happens? When other regions start competing for the same metal, because silver is not a market where everyone can be satisfied at once. It's too small, it's too essential, and the supply response is too slow. That supply response point is crucial. People assume if price rises, supply rises. With silver, it's not that simple. New mines take years to develop, or grades decline, costs rise, permitting takes time. And a big portion of global silver supply is produced as a byproduct of mining other metals. That means silver production is often tied to the economics of copper, lead, zinc metals that drive broader mining decisions. So even if silver becomes more valuable, supply doesn't automatically surge next quarter. The market can remain tight for longer than people expect. And in that environment, premiums can become persistent. Now bring in the liquidity angle again, because this is what makes the whole situation dangerous. When liquidity cracks, price discovery becomes less reliable. You start seeing moves that look irrational, spikes, gaps, sudden reversals, but they're not irrational. They're the market revealing that the depth people assumed was there is not there when it matters. This is where banks and large intermediaries become the main characters. Retail investors often focus on narratives. Institutions focus on risk. If the silver market begins showing signs of a physical tightness premium, banks have to evaluate their exposure, especially if they are involved in financing, hedging, or making markets in silver-related products. In a calm environment, they're comfortable providing liquidity. In a stressed environment, their instinct is to protect themselves. Protection looks like this. Tighter terms, reduced willingness to lend metal, more cautious positioning, less aggressive market making, and an increased preference for holding rather than circulating inventory. None of this is announced on television. It shows up quietly in how icily large buyers can source metal and at what cost. That's why banks are nervous matters. Not because banks are emotional, because nervous banks mean the system is becoming less elastic, and less elastic systems break faster when pushed. Now, let's talk about the $10 gap specifically, because the concept is powerful even when the exact gap fluctuates. A $10 gap can form from a mix of a strong local premium in the physical market, widening spreads between contracts and immediate delivery, and the cost of sourcing the right form of silver. When premiums widen, they act like a magnet for attention. People see the gap and assume arbitrage will close it quickly. Sometimes it does. But if the real constraint is logistics, delivery, and inventory, arbitrage is not clean. It becomes risky. You might buy the cheaper price, but can you get the metal where it needs to be, on time, without losing money to financing and delivery delays? In stressed markets, the answer is often no. That's why gaps can persist and even widen. Now, here's the question every American viewer should be asking right now. If silver is cracking in one of the most industrially hungry regions on Earth, what does that imply about the next phase of global pricing? It implies one of three outcomes, and none of them are boring. Outcome 1, the global price rises to meet the physical reality. The market reprices upward to reduce demand, attract supply, and close the gap. Outcome 2, the premium collapses because demand suddenly weakens, usually due to economic slowdown or policy tightening. That's possible, but the key is this: even in slowdowns, industrial demand doesn't vanish, and silver can behave unpredictably because financial flows can increase during uncertainty. Outcome 3, the market becomes more fragmented, with repeated episodes of premiums and gaps, meaning volatility becomes the new normal. That third outcome is what liquidity cracking tends to lead to periods where everything looks stable until a wave hits and the market jumps to a new level. So, how do you know which outcome is unfolding? You watch behavior, not commentary. If global silver continues rising while the physical premium remains elevated, that suggests physical tightness is real and persistent. If global silver pulls back but the premium stays high, that's even more telling because it means physical demand is not letting go even when paper price cools. If both global price and premium cool together, it suggests the pressure is easing. The point is, the premium and availability signals often lead the chart. Now, let's talk about why this matters for America, beyond silver itself, because this is where viewers feel the value. A cracking silver market is not only a stress signal for the broader system. Silver is embedded in industrial production. If procurement costs rise sharply, it can pressure margins in sectors tied to renewables, electronics, and infrastructure that can influence prices downstream. It can contribute to inflation persistence in certain categories. It can slow project timelines if supply becomes constrained. And it can show you something deeper about the macro environment. When hard assets start repricing quickly, it often means markets are questioning stability, either inflation stability, currency stability, or liquidity stability. In other words, silver doesn't just move because people like silver. Silver moves because it sits on the fault line between the financial system and the real economy. That's why it can explode. And now we reach the most important part, the part that explains why this could move faster than most people expect. When a market is calm, paper price leads and physical follows. When a market is stressed, physical leads and paper chases. The moment silver truly enters a new regime is the moment the market flips from paper-led to physical-led. That's when price stops being negotiated by traders and starts being dictated by availability. That is the moment price control fails. And once price control fails, silver often doesn't climb its sprints. So here's the final thought to leave you with. And it's the cleanest way to understand the entire China $85 story without getting trapped in the exact tick. When you see a major region paying a large premium for physical silver, you are watching the market reveal its weak point. You are watching the moment the system admits it might not be able to deliver metal smoothly at the old price. The question isn't, is it exactly $85? The question is, if liquidity is cracking now, what happens when the next wave of demand hits, when investors chase, when industry locks supply, when intermediaries tighten, and when the market realizes the cushion is thinner than it assumed? That's the setup. That's the warning. And if the crack widens, the move that follows won't wait for everyone to understand it first.